Friday morning, January 30th, 2026. Gold crashes $268 in a single session. Silver plunges nearly $17. Billions in wealth evaporating before breakfast. What happened? The official story. President Trump nominated Kevin Warsh as the next Federal Reserve Chairman. Markets panicked about higher interest rates. Traders sold. End of story. But here's what they're not telling you. This isn't just about interest rates. This is about a much deeper question that governments have been avoiding for decades. Who actually controls the world's gold? And when push comes to shove, does paper ownership mean anything at all? Today, we're connecting two stories that the financial media is keeping carefully separate. The market panic you saw on Friday morning, and the uncomfortable truth about whether countries actually own their gold reserves. By the end of this video, you'll understand why this week's sell-off might be the beginning of something much bigger. Let's dive in. First, let's talk about what happened Friday. Gold prices, down $268.60 to $5,050 per ounce. Silver prices, down $16.83 to $97.96 per ounce. U.S. equities, declining across the board. Treasury yields, rising sharply. The dollar, strengthening. This is what markets call a risk-off move, triggered by monetary policy expectations. President Trump announced Kevin Warsh as his nominee for Federal Reserve Chair. The announcement came after reports Thursday night and a White House meeting earlier in the week. Who is Kevin Warsh? Here's what you need to know. He served on the Federal Reserve Board from 2006 to 2011 during the financial crisis. He's been a vocal critic of aggressive monetary easing. He's warned repeatedly about inflation risks. And most importantly, he's called for the Fed to reduce its balance sheet dramatically. Wall Street's interpretation. Warsh means higher interest rates for longer. No more easy money. No more accommodative policy. And when interest rates rise and the dollar strengthens, precious metals typically suffer. That's the textbook explanation. The sell-off was brutal, but orderly. Profit-taking accelerated. Futures contracts were liquidated. Positioning was adjusted. Financial analysts called it a correction in an overheated market. After all, gold and silver had delivered historic gains. A pullback was healthy and expected. But here's the problem with that narrative. It ignores what's actually happening in the physical gold market. Because while paper gold crashed on Friday, something very different was happening in the world of actual, touchable, physical gold bars. And that's where our second story begins. Let me ask you a question. When you hear that the United States has 8,133 tons of gold reserves, what do you picture? Probably Fort Knox, right? Massive underground vaults, armed guards, gold bars stacked floor to ceiling, all safely stored on American soil. Here's the uncomfortable truth. That's not how it works. Not even close. Most countries don't physically hold their gold reserves in their own territory. Instead, their gold sits in a handful of foreign vaults, primarily in New York and London. The Federal Reserve Bank of New York holds approximately 6,000 tons of gold on behalf of foreign central banks. That's more than most countries claim to own outright. Why? The official explanation is convenience. During the Bretton Woods era after World War II, when currencies were backed by gold, it made sense to centralize storage. If Germany needed to settle a debt with France, they could just transfer ownership of bars sitting in New York's vault instead of physically shipping gold across oceans. It was efficient, logical, practical. What it actually became was a system of financial control. Let me tell you a story that should terrify every finance minister on earth. In 2012, Germany did something radical. They asked to see their gold, not buy more, not sell it, just see it. Verify that the 3,400 tons of gold bars registered in their name actually existed in the Federal Reserve Vault. The Fed's response was polite but firm. That's going to take a while. How long? 7 years. Germany, the fourth largest economy on Earth, had to wait 7 years to get back a portion of their own gold. And when they finally received it, some bars had different serial numbers than what they'd originally deposited. Think about that. If you can't access your gold, if you can't verify it's there, if you need permission to move it, do you really own it? Germany wasn't the first to notice this problem. In 2011, Venezuela's Hugo Chavez demanded his country's gold back, all 160 tons of it, stored in foreign vaults including the Bank of England. The Western financial establishment treated this like a radical, irrational move. How dare a sovereign nation want physical control of its own assets? But Chavez understood something crucial. Paper claims aren't the same as physical possession, especially when geopolitical tensions are rising. Venezuela got most of its gold back after months of tense negotiations. The process was humiliating, expensive, and deliberately slow, but they got it, and the world was watching. Visual. Timeline of repatriation movements 2012-2025. Since then, there's been a quiet but significant trend. Germany repatriated gold from New York and Paris ahead of schedule. Netherlands brought home 122 tons in 2014. Austria repatriated 110 tons. Turkey pulled nearly all its gold from the U.S. Poland secretly flew home 100 tons from the Bank of England in 2019. Hungary repatriated everything and put it on public display to prove they had it. Every single one of these moves faced logistical complications and diplomatic pressure. The message from the financial establishment was clear. We don't want you taking physical control of your reserves. Why not? Here's where we need to talk about something called gold leasing and hypothecation. When your gold sits in the Fed's vault, it doesn't just sit there collecting dust. The Fed and major banks engage in a practice where they lease that gold to bullion banks, who lease it to others, who use it for various financial operations. Think of it like fractional reserve banking, but with gold. The same physical bar might be claimed by multiple parties on paper. As long as nobody asks to actually see their gold at the same time, the system works perfectly until it doesn't. There's a theory among gold market analysts that the amount of paper gold, claims on gold through futures contracts, ETFs, and certificates, far exceeds the physical gold available to back those claims. Some estimates suggest the ratio is 100 to 1 or higher, 100 claims for every actual bar of gold. If even a fraction of gold owners demanded physical delivery simultaneously, the entire system would collapse. This explains why the Fed might resist returning gold quickly. They may need time to actually locate and consolidate physical bars that, on paper, belong to Germany, but in practice have been leased out multiple times over. Want to know something even more disturbing? The United States claims to hold 8,133 tons of gold, the largest reserves in the world. When was the last comprehensive independent audit? 73 years ago. There have been partial inventories, but no complete independent audit with outside verification. Members of Congress have repeatedly called for a full audit. It never happens. The official explanation? Security risks. The cynical explanation? A real audit might reveal uncomfortable truths about what's actually in the vault, how much has been leased out, or whether the bars even exist. Now let's talk about the modern gold market, where this disconnect has reached absurd levels. The COMEX gold futures market trades massive quantities of gold contracts daily, but the actual physical gold available for delivery is a tiny fraction of contracts traded. Gold ETFs allow investors to buy shares of gold. You own a claim, but you'll never touch a bar. All of this is built on one fundamental assumption, that only a small percentage of paper gold holders will ever demand physical delivery. What happens if that assumption breaks? Now let's connect Friday's market panic to this deeper story. Kevin Warsh represents tighter monetary policy, higher interest rates, a stronger dollar, reduced Fed balance sheet. In the short term, yes, this pressures gold prices. That's why we saw the sell-off. But here's what the smart money understands. Warsh's appointment might actually accelerate the very crisis that reveals the paper gold illusion. Why? Because while Western countries squabble over repatriating old reserves, something much bigger has been happening in the East. China has been buying gold aggressively for over a decade. Official figures show 2,200 tons, but nobody believes China's official numbers. Analysts estimate their actual holdings could be 5,000 to 10,000 tons or more. And crucially, China stores virtually all of it domestically. They're not trusting New York or London. Russia similarly accumulated over 2,300 tons before Western sanctions. When those sanctions froze Russia's dollar reserves, their gold remained untouchable because it was in Moscow. That's the lesson. When geopolitical tensions rise, paper claims mean nothing. Physical possession is everything. Visual, interest rate chart, dollar strength index, geopolitical tension indicators. Now, Kevin Warsh takes over the Fed. Interest rates stay higher. The dollar strengthens. Global financial conditions tighten. What happens when the next crisis hits? When countries need liquidity? When trust in the dollar wavers? They'll want their gold. Not paper claims, not promises. Actual physical gold bars. And that's when the system breaks. Visual, delivery demands, vault logistics, lease agreements, bank panic scenario. Because if multiple countries simultaneously demand physical delivery, if investors panic out of paper gold into physical, if the 100-to-1 ratio is exposed, the Fed won't have 7 years to fulfill requests. They'll have days, maybe hours. And what happens when they can't deliver? Friday's sell-off might not have been about higher interest rates at all. It might have been about sophisticated traders understanding that tighter monetary policy increases the probability of the scenario where everyone asks for their gold at once. You might be thinking, I don't own gold. I'm not a central bank. Why should I care? Here's why this matters. Gold isn't just a shiny metal. It's the ultimate backup system for the global financial order. When currencies collapse, when banks fail, when trust evaporates, gold is what remains. Central banks know this. That's why they hold it. And that's why the question of who actually controls that gold matters enormously. If a major financial crisis hits and countries discover they can't access their gold reserves because the bars are leased out, don't exist in claimed quantities, or are stuck in bureaucratic delays, the entire system of international finance could unravel. The dollar's status as reserve currency depends on trust. Trust that America's institutions are stable. Trust that promises will be honored. Trust that the gold backing those promises actually exists. If that trust breaks, we're not talking about gold prices going up or down. We're talking about a fundamental restructuring of global finance. So, what should you do? First, understand that Friday's volatility is likely just the beginning. As Warsh takes over the Fed, as monetary policy tightens, as geopolitical tensions continue rising, expect more dramatic swings in precious metals prices. Second, recognize the difference between paper gold and physical gold. ETFs, futures contracts, and mining stocks are not the same as bars in your possession. If you're holding gold as insurance against system breakdown, paper claims won't help you. Third, watch the repatriation trend. If major countries accelerate efforts to bring gold home, that's a signal they're preparing for crisis. Don't ignore it. The Kevin Warsh appointment is significant not because of what it means for interest rates next quarter, but because of what it signals about the direction of global finance over the next decade. Tighter money, higher real rates, increased stress on a system built on leverage and trust, and at some point someone's going to ask for their gold back. And the answer might be, we don't have it. We're at a fork in the road. One path leads to a managed unwinding of the paper gold system, with countries gradually repatriating reserves and the market adjusting to reality. The other path leads to a sudden crisis where the gap between paper claims and physical reality is exposed all at once. Friday's sell-off? That was just traders repositioning for higher rates, but the smart money knows when the next real crisis hits, ownership won't matter nearly as much as possession. The question isn't whether countries own their gold. The question is, when the crisis comes, will ownership matter as much as possession? If this deep dive into the connection between Fed policy and the gold market's dirty secret opened your eyes, smash that like button. And let me know in the comments, do you think Fort Knox is full or empty? Thanks for watching. And remember, in a world built on trust, the only thing that matters when trust breaks is what you can actually hold in your hands. I'll see you in the next one.